All right, today we're diving into the world of mining. It's this massive global industry, but it has to play by a rule that would seem completely insane to most businesses. And that rule is you have absolutely no control over the price of the very thing you sell.
I mean, just think about that for a second. How do you possibly win a game where you can't even set the price? Imagine you're running this huge multi-billion-dollar company, but you have zero say in what your product sells for. That is the reality for mining companies every single day. It's this wild paradox, and if you can get your head around it, you're on your way to understanding this entire industry.
And look, this isn't just my opinion. This is a core principle of the industry. You have major rating agencies like Standard & Poor's who flat out say it. Even the biggest players are price takers. That's the official term for it. It means you don't make the price, you just take whatever the global market decides to give you.
So, let's get into this price taker's paradox. Why does it even exist? I mean, what makes digging stuff out of the ground so different from selling, I don't know, a new iPhone or a piece of software? Let's break it all down. Okay, so the heart of the issue is actually pretty simple. Minerals are commodities. Iron ore from a mine in Australia is, for all intents and purposes, the exact same as iron ore from a mine in Brazil. There's no fancy brand, no special features. And when your product is identical to everyone else's, what do you compete on? Price. That's it. If you try to charge even a tiny bit more, your customers will just go, nope, thanks, and buy from the other guy.
All right, so if you're a miner, you can't control the price. That's a huge deal. But what else is out of your control? Well, turns out there are a couple of other massive forces they're constantly fighting against. The crazy swings of the global economy and the heavy hand of government. You know, the mining industry is famously cyclical. It rides the waves of the global economy like almost no other business. I mean, think about it. When do we need the most metal? It's during economic booms, right? When we're building skyscrapers, bridges, millions of new cars. But when things slow down, that demand for minerals can just fall off a cliff, and the price goes right down with it.
And this cycle creates what you could call the boom-bust trap. Here's how it works. An economic boom hits, demand for metals is through the roof, so companies go, great, let's invest billions in new mines. But here's the kicker. It can take more than 10 years to actually build a new mine. So by the time that shiny new mine finally opens, what's happened? The economic cycle has often already turned south. All of a sudden, you've got this flood of new supply hitting a market where nobody wants it. And the result? Prices completely crash. This is exactly what we saw with iron ore back in 2015. China's demand slowed down right as a bunch of massive new mines came online. It was a perfect storm.
The other huge uncontrollable force? The government. And it makes sense, right? Miners are literally digging up a country's national resources, its wealth. So of course, governments are going to be heavily involved. They're the ones who decide who even gets a license to mine and how much they can take out. And you better believe they're going to take a big slice of the pie through heavy taxes and royalties. The really tricky part, though, is that these rules can change overnight. A new election, a shift in policy, and suddenly the whole game is different. This political risk is a constant, unpredictable threat, especially in developing nations.
Okay, so let's recap. You can't control the price, the market is a total roller coaster, and the government is breathing down your neck. It sounds like a completely impossible business, right? But it's not. The best companies, the ones that thrive, do so by focusing with laser-like intensity on the few things they can actually control. And really, this is it. This is the whole game plan right here. You can't control the price of your product, but you can control your production costs. You can control how much it costs you to get that stuff out of the ground. This right here is the single most important battleground in the entire mining industry. So this is the key takeaway. Being a low-cost producer is the ultimate advantage. It's everything. In mining, you're not really competing on having a better product. You're competing on survival. When prices are high, hey, everyone's making money. But the low-cost guys are making the most money. And more importantly, when that cycle inevitably turns and prices crash, they're the ones who survive. They can still turn a profit, while their high-cost competitors are just bleeding cash, maybe even shutting down completely.
So how do they do it? How do they get those costs down? It's a non-stop, relentless push for efficiency. We're talking about investing in gigantic automated trucks that run 24/7. It means building their own private railway lines because transportation is such a huge expense. Some even build their own power plants to lock in cheap energy. Every single step of the operation is squeezed and optimized to shave just a few more cents off the cost of every single ton of ore. The second big lever they can pull is just pure brute force scale. Being massive creates what we call economies of scale. Think of it this way. You can spread all your huge fixed costs, the machinery, the infrastructure, over way more tons of ore, which brings the cost for each individual ton way down. Plus, being a giant gives you incredible bargaining power with your suppliers, from everything from truck tires to explosives. You get to demand better prices, squeezing out even more savings.
The third lever is a classic business strategy: diversification. I mean, why bet the entire farm on just one mineral, like iron ore? You can also mine copper or lithium. Their prices don't always move in the same direction, which helps create a much more stable business. And it's not just about minerals, it's about geography too. Why have all your mines in one country, where they're vulnerable to a single political change or a natural disaster? Spreading your operations all over the globe builds a much more resilient company that can handle those kinds of local shocks.
And the last big lever is something called vertical integration. This is when a company doesn't just dig the ore out of the ground. They also own the next step, the processing plants that turn that raw ore into finished metal. By doing this, they're capturing more profit all along the value chain. It makes their business a lot less volatile than a company that's just a miner, completely exposed to the whims of the raw commodity price.
But even if you're the most efficient, the biggest, and the most diversified miner out there, there are other risks, ones that are kind of lurking just below the surface. These are the environmental and social challenges that can stop a billion-dollar project dead in its tracks.
So let's talk about a key term here: tailings. When you've extracted the valuable mineral from the rock, what's left over is this waste material. It's basically super finely ground rock, and it often contains some pretty harmful toxic stuff. This has to be stored safely in these massive dam-like facilities, basically forever, and managing this waste without causing an environmental disaster is a huge, expensive, and critical responsibility. And that brings us to this really important idea of a social license to operate. See, you can get all the government permits and approvals in the world, but if the local community is dead set against your project because they're worried about pollution or being displaced, you've got a massive problem. Protests, blockades, public opposition, this stuff can cause huge delays and can even shut down a mine completely. You need the community's buy-in.
Okay, so we've looked at the uncontrollable forces, the winning strategies, and all those hidden risks. So what does a strong mining company actually look like when you put it all together? Let's sum it all up.
This table really lays it all out perfectly. It's the anatomy of a miner. On one side, you have the weak miner. They're a high-cost producer, probably with just a single mine, completely exposed to the price of one mineral and the politics of one country. But the strong miner? They're the low-cost leader, operating at a massive scale. They're diversified across different minerals and different parts of the world. And often, they're vertically integrated to capture more of that value and protect themselves from volatility. That is how you win this price taker's game.
And this brings us to one last big question as we look to the future. We've seen that winning in mining today is all about efficiency, about getting more stuff out of the ground for less cost. But as the world starts to focus more and more on sustainability and recycling, you have to wonder if the definition of a great miner is going to change. Will the winners of tomorrow be the ones who are just the best at digging, or will they be the ones who help us innovate and create a world where we need to dig less in the first place? It's definitely something to think about.